Yeah, I would say that most REITs have been very disciplined about managing their interest rate risk. As rates have risen, they've been very disciplined about swapping floating rate debt to fixed at closing, or in some cases even before closing.
Joining me today is Paul Elsen, Director of Hedging and Capital Markets with Chatham Financial. Paul, thanks so much for joining us.
Thanks for having me.
Now, what are you expecting regarding interest rates for the rest of 2024 and heading into 25?
With regard to short-term rates, we know that SOFR is around 5.3%, and everyone kind of is expecting the Fed to cut rates at some point. Well, right now, Fed funds futures are implying about 2 or 3 rate cuts over the remainder of 2024. And I think the Fed would really love to cut rates, but they're certainly not going to do that at the expense of their inflation mandate, right? And where we sit today, things aren't looking great. CPI in October, this is core CPI, was at 4.0%, 4.0 year over year. 4 months later, in February, it was 3.8. So 0.2% improvement, like not really what we're kind of looking for. At that rate, it's going to take a long time to get to 2%, right? So I think the Fed would like to move, but they're certainly not going to do it before they're confident that we're going to hit that 2% level. So that makes me think that there's really a growing chance that we won't actually see a cut this year. I hope that's not the case. I hope we do see some cuts, but just trying to be realistic. It's difficult to know. With respect to long-term rates, I really kind of think about this just in terms of supply and demand factors, right? And with our current budget deficits, the Treasury is issuing record amount of debt, right? So there's a ton of supply. At the same time, the single biggest traditional buyer of Treasuries over the last 5 years has been the Fed. Okay, their balance sheet is about $7 trillion in size. They own about $7 trillion of Treasuries. And our total public debt issued by the Treasury is about $35 trillion. So $7 trillion held by the Fed, 35 total, it's about 20%, okay? So as Treasuries are maturing, the Fed is not reinvesting those principal proceeds back into buying more Treasuries. And with the Treasury issuing record amounts, that creates a big gap in demand, right, which has to be filled. And I think that's why we're seeing yields rise. And I wouldn't be surprised if we continue to see them rise.
And can you please give us an update on what you're seeing companies do on the hedging derivatives front, and if there are any new ideas or products that you've seen in light of the current market conditions?
In terms of hedging, it's, we're in a downward sloping yield curve environment, right? And so, interestingly, there's actually a benefit to hedging out further, hedging longer rather than shorter. A 3-year swap is below a 1-year swap rate, a 5-year swap rate's below the 3-year, and so on. And so we have seen clients, take advantage of that and hedge out further than they otherwise might. In terms of, products, we still see caps and interest rate swaps as the most common for hedging floating rate debt. And then on the pre-issuance hedging side, where clients intend to issue fixed rate bonds or fixed rate mortgage or fixed rate private placement, we're doing a lot of hedging with Treasury locks and forward starting swaps. But we're seeing more clients do more scenario analysis around what are their financing alternatives, and if they shift gears, can they use hedge A to manage risk for a financing like their B financing. And so we're definitely seeing kind of more flexibility there and more creativity.
And finally, are there any hot topics on derivatives or hedging that our viewers should be aware of?
Yeah, I think that in this just very uncertain environment, it's a tough financing market right now, and you have to be flexible, I think. You need to be flexible in terms of your financing plans. And so I think it's just more important than ever to stay in close contact with your derivatives advisor and your hedge accounting advisor, and just make sure that you're avoiding the biggest pitfalls and hopefully achieving the best outcomes for your situation.